Dear students, in this video I will explain to you the concept of the net present value, which is one of the most important concepts in corporate finance. The basic question we want to answer is which investments should a company make? Usually there are all kinds of investments out there and we don't know which of these investments is really worth to be undertaken. And we would like to select those investments that create value for the company, whatever that is. And the net present value will help us to determine exactly which projects create value. What now is the value of an investment? We typically think of an investment as generating cash flows in the future. Hopefully, these cash flows are positive, which means that they represent inflows into the company. This is the money we earn from a project. These cash flows can occur at different points in time, often over multiple years, and this means that we cannot simply add them up and interpret the sum of all these cash flows as the value of our investment. In addition, the cash flows may also be uncertain. Uncertain with respect to the amount, but also with respect to the timing of the cash flow, or whether they will occur at all. So this uncertainty, as well as the timing, is considered in the net present value, which we will use as our central valuation concept. The NPV rule considers all cash flows associated with an investment, the initial investment outflows as well as the future inflows. It considers the amount of these cash flows, the timing of these cash flows, and also the potential risk associated with these cash flows. As we deal with cash flows that occur at different points in time, we need to make these cash flows comparable. And otherwise, we would compare apples to oranges. And what we really want to do is to compare apples to apples. We already know that a euro today is worth more than a euro tomorrow. This is the time value of money. Cash flows that occur earlier are worth more than cash flows that occur later. And this means we have to discount the later cash flows by a certain factor to make them comparable to the earlier cash flows. And the rate we use for this discounting procedure depends on the risk-free rate, but also on the risk that is involved in our project. And we typically use the rate that is similar to an alternative investment that bears the same level of risk as our project. This is what we also call the opportunity cost of capital. The return that any investor would give up to invest in our project as opposed to some other project that is available. Discounting in practice is related to our interest rate calculations we did earlier. The time value of money, again meaning that a euro today is worth more than a euro in the future, is reflected by the fact that you could use this money today to invest it and to earn interest until this point in time in the future. So if we now assume that we have 1 euro and there would be a 5% interest rate available that we could invest this euro for, then we can see at this timeline here how this 1 euro would evolve over time. As we know, after 1 year, there would be an interest of 5%, so that we would have 1 euro and 5 cents, which would then over the years, due to compound interest, grow to a final value then of 1 euro times 1.05 to the power of capital T in the year capital T. So this is what we know from our interest rate calculations, and for discounting we simply have to apply the same principle backwards, meaning that any amount in the future can be transferred back to the point in time today by dividing it with the respective interest rate. So here we see the amount in T1 is divided by 1.05, and equivalently the amount in T2 is divided by 1.05 square. And this goes on until the amount in capital T is divided by 1.05 to the power of capital T. The discounted amount of any cash flow is what we call its present value. So if we expect a cash flow in period 1, so 1 year in the future, its present value is just the amount we get after 1 year divided by 1 plus R. And R here is the discount rate. This is the interest rate we use to discount the future cash flows. And as we said, it has to represent the time value of money and also the risk of the project. An alternative way to express this is by a discount factor. So the discount factor is just 1 over 1 plus R. And with this we can then rewrite the present value as the future cash flow times the discount factor. These are just two different ways to express the same thing. And of course, this does not only work for 1 year, we can apply this to any future cash flow at a future point in time t, which represents the number of years in the future this cash flow occurs. And then the present value is just this cash flow in period t divided by 1 plus R to the power of t. Or alternatively, the discount factor for t periods, which is 1 over 1 plus R to the power of t. And after we gathered all these present values for the future cash flows, we can now add them up because they now relate to the same point in time, which is today, and therefore the present value of these different cash flows is additive. This additive nature of the present value makes it very easy to apply it to a stream of future cash flows, meaning that there are several cash flows at different points in time in the future, but the present value of these cash flows just is the sum of all these individual cash flows after they have been discounted. So I take the cash flow in year 1, discounted by 1 plus R to the power of 1. Then I take the cash flow at year 2, discounted by 1 plus R to the power of 2, and so on and so forth until capital T. And by summing them all up, I get the present value of this stream of future cash flows. And now we can also take into account the initial investment, which usually is an outflow, meaning a negative value, and take this into account. And this is then what we call the net present value. So the net present value just is the present value of all the future cash flows plus the initial investment we make in period 0. And this number here is normally negative because it represents an outflow. And then using the notation above, we reach this expression here, initial investment plus the present value of the future cash flows. Or if we want to write this a little bit shorter, we simply have the net present value as this sum, which now starts at 0, of course, because it includes now this initial investment in period 0. And of course, when we take 1 plus r to the power of 0, this disappears because it is 1, and we are left just with C0. So these two expressions are really the same. So we've now learned a very powerful concept, the net present value, and it can be applied to all kinds of evaluations. First of all, as we used it so far, thinking about investment projects, real investments of companies, but it can also be applied to the value of financial securities, for example, stocks and bonds, as we will see later in the lecture. And as we saw that the net present value is additive, it can also be used to value complete businesses, which is then often called a discounted cash flow valuation. And valuing businesses is important, for example, in mergers and acquisitions, or for setting the price in an initial public offering, an IPO.